This video is about intraday trading in options. Introduction. Options trading is very risky, so let's be very aware. What is the first screen which you see when you log into your trading terminal of your broker, which can be Zerodha, Dhan app, anything? Please pause and read carefully what it says, and that is very, very important because that is based on the actual data which has been collected by the exchanges, stock exchanges, for the last 1 year. This is the screen, below is the screen which pops out when you first sign into your trading terminal of your broker. Please read it carefully, as that is important before we proceed and discuss methods of doing options trading. 9 out of 10 individual traders in futures and options segment incur net losses. That is 90% of the people who trade, individual traders, which means small traders, retail traders like you and me, they incur losses. On an average, people registered net trading loss close to 50,000 rupees. That is for 1 year data, financial year 2021-22. Over and above the net trading losses incurred, loss makers expended an additional 20% of net trading losses on transaction cost. So please remember, even if you exit a trade, close a trade in profit or in loss, there are other charges also which are deducted, which are basically the transactional charges, such as different taxes, exchange charge, stamp duty, GST. So that is deducted irrespective whether you make a profit or you make a loss. So if you close a position in loss, plus another amount is also deducted, so that is a double whammy. Those making net trading profit incurred between 15 to 50% of such profit at transactional cost. So these transactional costs are huge. Before we start options trading, please be aware, options trading is very risky. 9 out of 10 retail traders lose. Do not do options trading for fun and gambling. This is not something which should be taken lightly because actual money is involved, your hard earned money. Don't do options trading solely based on tips, advice, someone's recommendation, YouTube videos, because that person is only interested in making his own money, his own profit, and not helping you to make profit. Even if someone's tip makes you earn some profit, that is by chance. Eventually you will lose your money capital, and that will also make you lose your mind and confidence. Your psychology and your mental confidence is very important when you are doing options trading. A strong, positive, cool mind, discipline, knowledge, and confidence are most needed in options trading. In this video, my target is to make you an independent trader. Please watch this video till the end. Let's also understand why options trading is risky, and so that we can be knowledgeable and serious about it. Options trading is a zero sum game. What it means? It means if someone makes a profit of 1000 rupees, it means someone has lost 1000 rupees. And also 9 out of 10 people lose, especially small traders. Then it begs the question, who wins if option trading is a zero sum game? If 9 people are losing, then there must be some people who are winning. Someone is winning. Any guesses? Most of the time, the options sellers are winning. And there is a very profound reason to that. We will come to that reason in this video. Even if I have told you the reason, my recommendation still would be that you start as an option buyer, as buying option requires small amount of capital and also it is less risky. Even if worse come to worse, maximum you lose is limited to the options premium amount compared to option selling, which is much more risky, and on paper the losses can be unlimited. Though it never happens, rarely happens, but on paper, theoretically, when you are selling options, your losses are unlimited. Let's understand quickly by taking an example. Let's say I am buying one lot of Nifty 50, which in India is 50 quantities. Let's say premium is 120, so the required capital is 6,000 rupees. And if I'm selling same Nifty 50 call option, one lot which is 50 quantity, premium also is 120, the broker would want a margin requirement of around 1,10,000 rupees approximately. So when I'm buying it, it's 6,000 rupees for one lot of Nifty 50 CE call option, and when I'm selling one lot of Nifty 50 call, it requires me to have 1,10,000 rupees in my brokerage account as margin money. So see the vast difference of capital requirement. Now I have taken a trade which is based on, let's say, some kind of setup, some analysis, and the market moves in my direction. Very good. And premium changes 20 points. So I'm in profit now. So 20 points at the rate of 50 quantity equals 1,000 rupees, and now based on some conditions I think that this is where I should exit and book the profit. So when, if I have bought, in my buying scenario, if I bought a call option and I have made a profit of 1,000 rupees, so over a capital of 6,000 rupees, my profit percentage is 16.7%, which is very good. Small trade, small capital, one single trade, one lot, buying and then selling. Maybe the trade has taken 20 minutes of my time and I have earned 16.7% on my capital. But if I was in the selling scenario, so there my profit would be 0.9%. See the vast difference. 1,000 rupees on 1,10,000 rupees percentage, profit percentage is not even 1%. In real world, there will be additional charges also which will be deducted from your trade, so this will make the profit margin even lesser. So when I'm selling options, my profit will be even lesser than 0.9%, because there will be different charges such as brokerage, SEBI turnover fees, exchange turnover fees, stamp duty, transaction tax, GST tax. So all these charges my broker is going to deduct from my trade value or the profit. Even loss, if I am in loss, these charges will still be calculated and deducted, so I'll be in double loss. So this is eventually going to reduce my profit and profit percentage. Coming back, painful part is above charges are deducted from your money even when you have exited your trade in loss. In real world, these scenarios which we discussed, where I am buying a call or a put and selling it, is known as a naked position, and this is very risky in trade. If you do professional or you are a big trader, eventually you will always do hedging. You will always have hedged positions. But options hedging or entering a hedged position is another topic and is not relevant for our, at least for small traders and beginners. So let's keep things simple. So let's start. So let's start with our trade. First decision is to which index we should choose for our options trading. Also, please know that we can also do stock options, but I'm not interested in that. Always it's better to do trading in index options. So different types of index options are Nifty 50, Bank 50, Fin Nifty in Indian stock exchanges like NSE, BSE, primarily NSE. The Nifty 50 index is well diversified, as the name says. It consists of a bouquet of 50 companies' stocks reflecting different sectors of the market. Nifty 50 index is computed using free float market capitalization method. Different sectors, diversified sectors such as IT, oil, metal, auto, financial services are well represented in Nifty 50. So it's a very balanced index. It consists of 50 actively traded stocks. The complete list of these stocks and their weightages in this index are available on the NSE site. Link is given. Uh, these 50 stocks keep on changing. That change is very less frequent, but the updated list is available on the NSE site. My suggestion is to trade in Nifty 50 index options, as Nifty 50 is well diversified and hence is less volatile. Next question is, so one question we have finalized ki which index to choose for options trading. My recommendation is Nifty 50. Now coming to whether we should do option buying first or do option selling. So as you know, there are two ways to trade in options. Either you can take a long position or you can take a short position. Long position or trade means the first step is you buy an option, whether C or P, based on some setup, based on some scenario, based on some analysis of yours. Always, it cannot be a random trade. And next is you finally sell, and hence your trade or position is closed. This is what 99% of retail or small traders do, as this requires obviously very little capital, and also the profit is huge. Even the risk is less. Second is short position or trade, which means the first step is to sell an option, maybe a call or a put, and then the next step is to buy it back so that my position is closed or my trade is closed. This is what is also known as option writing, which big traders, professional traders do. This obviously requires a very large amount of capital compared to buying, and the profit percentage is also less. Risk is very high. Most of the times the profit percentage is 3%, 5% to 10% of the capital. So my recommendation will be, we will do options buying, as it requires small capital and the risk is also small. So for example, if Nifty 50 index is going up and I see a bullish trend, then we will buy a call option, which is called an entry or taking a position or a trade, and then sell this call option when my target is met, profit target is met, or in worst case, if the trade doesn't go in my favor, so I have a stop loss and my SL is hit, so I close or exit my position. Second scenario is the index is going down, which is a bearish trend, and I buy a put option, which is an entry for me, and then sell this put option, which is exiting my position when my profit target is met, or if worst case the trade doesn't favor me, it goes against my calculation analysis, so I hit a stop loss and exit the trade. Remember, just to recap, options trading is very risky. 9 out of 10 retail traders lose. Why? Because the market is very volatile. There are many market movements. 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 Why? Retail traders do long trades. They buy see call or put first, as that requires less money and profit margin is high. Because option premium changes fast when index moves in your direction, this is called momentum. So let's understand, three things can happen in the market with near equal probability when you enter a trade. One scenario, index moves fast in your direction, which has one third of the chance, which is 33% of probability, and the premium also increases fast, so you are gaining, making profit. Two, second situation, index stops moving fast and it starts moving up and down or in a zigzag fashion, slowly in a small range. The market becomes range bound, which is called sideways market, for some time, maybe during a day for half an hour, 1 hour, 2 hours, 4 hours, maybe it remains sideways in a very small range. It is going up 10 20 points, nifty 50, it is coming down again 10 20 30 points, goes up 10 20 30 points. So that is a random behavior in a small range, zigzag going up down, so it's called sideways market. This condition, if it becomes, then premium don't increase, but they may start decreasing over time very slowly because of time decay. Third scenario is the index reverses, the situation completely changes, trend changes very fast, and the index start moving very fast in the opposite direction, and the premium starts decreasing fast, which also has 33% of probability. So a profit formula is my selling price minus buying price. For retail players who is carrying a long position, maybe he has purchased a call or a put option first, winning probability is scenario number one. When trade moves in your direction fast, there is a momentum and premium is increasing fast. Only in this scenario, a retail trader is going to make a profit, which is one third of the chance, so it has 33% of chance. It has 33% of probability of winning. But if you take a short position, so first step is you are selling a call or a put, so your winning probability will include two situations, the scenario number 2 and 3, and hence your winning probability becomes double, twice. Your probability of winning a trade which you have entered are double. So this is why there is more probability of winning when you are a call or a put writer, you are selling options. So how do we trade with a small capital or money? As this video has become long, I have released further session as another video. Please watch part 2, where we will continue this session. Thank you very much. Please like and subscribe to support my content.